So are you embarking upon the idea of buying your first home, but you don't even know where to start, and it's so bad that you might not know all the keywords or terms that are being thrown around by those around you? Then stay tuned, because today I'm going to go over key terms that you need to know when you are buying a home. Hi, I'm Jennifer Queen with the Jennifer Queen team and RE/MAX Professionals here in Winnipeg, Manitoba. And every year we help hundreds of buyers on our team buy, sell homes. So if you are curious to know what the terminology is that you should know, you've come to the right place. That is exactly what this video is about today. So without further ado, I'm going to start going through some key terms. If you're a little more advanced, it's okay if you skip over this video. However, there might be terms in here you find that you've never heard before. So completely up to you, but stick around if you want to just make sure you know everything. So number one, and I do think it's probably one we all have heard before, but just to be safe, let's start with the basics. The first term is mortgage. So mortgage is the money you are borrowing from a bank for the purposes of purchasing your home. It's essential though to understand that there are different types of mortgages available. Some people think there's a standard product, however there is not. There are terms like fixed rate, adjustable rate, variable rates, all different terminology used to explain mortgages. And I'm gonna get into that a little bit later. But just know that the mortgage in general, when we reference mortgage, it is the money you are borrowing. It is not the terms at which you are borrowing them. Number two, down payment. Now, down payment is something that is often mistaken with the deposit, but we want to keep the two separate. Down payment is that total percentage you want set aside to purchase your home. In Manitoba, it's in Canada. The minimum down payment on a home is 5% of your purchase price. Anything under 20% though means you're going to be paying some insurance premiums on it. Common one being CMHC, and I'll get to CMHC in a bit. Mortgage principal. So mortgage principal is the chunk of money that you are actually borrowing. This is the amount that you're going to be paying back plus interest over time. Number four, mortgage loan insurance. So that's what I was referencing earlier. Mortgage loan insurance comes into play anytime you have less than 20% to put down as your down payment. It's okay if you need to take out this insurance. Some people think when I say that it's a bad thing. It's really not. It's quite common. There's a lot of people with down payments between 5 to 19% of a home. Probably more common like 5 to 15, but a lot of people really do fit into that category, so it's not abnormal. The thing is when there's smaller amounts of money being put as a down payment toward a house, the risk factor for the banks does go up. So there are a few major insurers in Canada, the most popular being the Canadian Mortgage and Housing Corporation, or CMHC, that does a lot of the mortgage insurances here. But there's other options too. There's Genworth, I'm sure a lot of lenders use that one now too, among others. So just know that is what's going on behind the scenes. There will be a premium assessed, and there are actually online calculators if you go seek them out. Just Google CMHC mortgage insurance calculator. They have a good tool, I've noticed. And you essentially enter the purchase price, your down payment, and it spews out the calculations for you. Now, when it gives you that number though, you're going to want to talk to your lender, because you don't necessarily have to pay that chunk of money up front. A lot of the time the premiums are looped into your monthly payments. So it's not something you have to worry about so much or set aside this chunk of money for. Just know it's something that's going on kind of behind the scenes. You are paying for it. And the goal is, of course, that maybe you pay that on your first home, but then once you've built up that equity, next time you're not going to have to pay it. You'll have that 20% down payment saved. Number five is a pre-approval. Now, I want to stress there is a difference between a pre-approval and a pre-qualification. I made this mistake too. When I was buying my first home, I did a pre-qualification, and essentially they asked a few questions based on income, savings, yada yada, and then they approved me. However, turns out when I had to go get the proper approval for the mortgage, there were a lot more hoops to jump through, and a pre-qualification is worth very little. It's not as in-depth of an application. Pre-approvals, on the other hand, are going to feel fairly invasive when you first go to get them done, but it's for a reason. It's because the lender is literally doing about 70% of the work up front, for the mortgage portion at least, so that they can pre-approve your mortgage. So essentially, the remaining 30% is so when you go out, you find a home, the bank is then looking at the home, and they're also sending it to final underwriting, but as much of the legwork that can be done is done up front. It's incredibly important to get a pre-approval in place in advance of even looking for homes. I know a lot of people love the idea of getting out to see if there's anything they like, but inevitably they always do find something they like, and then they start the pre-approval process, but that's actually doing it backwards. Always get that number first so that you know a realistic budget of what you're working within, and make sure you're getting a pre-approval, not a pre-qualification. Number 6 is closing costs. So you probably hear this term thrown about a fair bit. It is kind of an umbrella term in that it covers everything that isn't really your down payment, all the other fees associated with closing. Legal fees are in there, land transfer taxes would be in there, moving expenses, and then a variety of other things, but those are the big ticket items. And when people hear closing costs and that there's another big potential bill coming their way, they're not cheap. If you've set aside 5% down payment, you're not done there. I will warn you of that. It's a good rule of thumb, and it really depends on the price of the home you're buying, but as a rough rule of thumb in general, put aside about 2% of the purchase price for closing costs. Interest rate. So this is the percentage you are agreeing to pay on an annual basis to your bank for the money you are borrowing. The rate at which you are paying can substantially impact your monthly payments. So there's a lot of people in the last few years that re-signed their mortgages below 2% at a fixed rate that are going to be coming up for renewal in the next little bit. Let's hope they've had a substantial amount of mortgage pay downs so that the new mortgage payments aren't too painful. But interest rates have a huge impact. And if you actually look at the pay down of your mortgage over time, you pay much heavier interest earlier in your mortgage term than you do later on. So there's some strategies on that. I've always thought too that there's no harm in making extra payments every year as long as your mortgage provides for that. Number 8 is amortization. So amortization is different from mortgage terms. So if you are taking a mortgage term out, a lot of the time they're broken down into 1, 2, 3, 4, 5 years. I have seen some 10 years, although they're less common and not very popular. 5 years, I believe, is the most popular for a fixed rate mortgage, but don't quote me on that. But amortization is not that, because if you are taking out a mortgage for, say, an average price home here in Winnipeg, which right now is just under that 400 mark, around the 370 mark, there's no way that the average person would be paying that off in 5 years, which is the typical term rate. Rather, amortization is the schedule over which they're anticipating you to pay that mortgage off. And typical amortization periods are about 25 years. So yes, at the end of the 5-year mortgage term, you will still have money owing on the principal balance of your home, unless you've been some kind of wizard and sleuth with your numbers, in which case congrats to you. But most people do not have their home paid off in that period of time. The most common period for amortization is 25 years here, but you can get terms anywhere from 15 all the way up to 30, I heard recently, which was for a while ruled out. But there is quite a spread. So kind of going back to that, so amortization is this period over which they anticipate the mortgage being paid off, whereas mortgage term is the period at which this interest rate will be fixed for this period of time. So typical is anywhere from 1 to 5 years. Number 10, so fixed versus variable mortgages. In the last 2 decades, at least in Manitoba, Canada too, if you had picked a variable rate mortgage, you were actually coming out ahead paying less interest overall than those in a fixed rate mortgage. And there's reasons for that. I won't get into it. Really, that's more of a mortgage broker question. But what I will say is it's important to know the difference between the two products. A fixed rate mortgage means you are locked in for a specific amount of time for a pre-specified rate. Your rate will not change if you signed. So again, back to the example of those renewing their mortgages in that March-April period 2020, there were some people getting mortgages for like 1.7% rate interest. They were signing that at 5 years. Those rates are insane to me because again, they are sub the goal for inflation, but hey, kudos to you if you're one of those people. Just know you won the lottery, in my opinion. A variable rate mortgage, on the other hand, though, is tied to the current interest rate, and it will fluctuate with the current market. So while many were coming ahead, where we start to see those with variable rate mortgages feeling the pinch is when the interest rates start increasing, which we're starting to see. So you're probably hearing a little bit more on the news lately about variable rate mortgages. There's no right or wrong answer. Well, I guess there is a right and wrong answer if you look at statistics in hindsight, but predictively, it is so hard to call. I always tell my clients to just trust their mortgage broker on their advice, but at the end of the day, go with what's comfortable for you. I know year over year, and I speak with mortgage brokers on a daily basis, I know that a variable rate mortgage has actually been a much more attractive option in terms of mortgage pay down over the last few years. However, for my own peace of mind, I still always like to do the fixed rate, knowing that that rate is locked in. I don't know, I'm one of those people, I guess, but it doesn't mean that there's a right or wrong. There's just some weight to be given to both sides of the coin. An open versus closed mortgage. So gosh, there's a lot of terms when it comes to mortgages. So if ever you want a cheat sheet, reach out. I actually do have one. An open mortgage, essentially what that means is there's provisions in your agreement that allow you to pay that mortgage off prior to the end of your mortgage term. So that 5-year example I gave you earlier. Where a closed rate mortgage, you might not have those same options without paying a substantial penalty, I should say. Now, I have heard of some exceptions being made to this. I have heard of some workarounds for this. It really depends on your situation. Maybe if you're buying another house, the bank will forgive some of the loan or allow you to port it, but this is one of those things you want to be crystal clear on, especially if you are selling something and moving into another. You don't want to have the surprise of a mortgage penalty assessed to you. And also, if you're buying and you're not sure how long you're going to be within the home, that's another thing you're going to want to weigh in the process, because heck, you don't want to decide this house isn't for you, or if it's a short-term plan 3 years from now that you want to sell it and you have this huge penalty to pay. Now, huge, usually not, but I have heard horror stories. So again, if ever you want an opinion on this, let me know. I do have a mortgage broker I trust wholeheartedly that I know will not give my clients bad intel and will advise on what you're looking at in terms of different mortgage products. Home inspections. So I'm sure you've heard of this. Anybody watching any reality shows on HGTV would have heard of this before, but a home inspection is a fairly thorough, although superficial, look through the home. Another thing I want to point out though is that there are varying degrees of home inspections. So a lot of people don't know about the add-ons they can have. Most home inspectors come out, they have their electrical testers, they have their screwdrivers, they're popping off the electrical panel to look behind, but there's further inspection that can be done as well. So some popular options are infrared cameras, drones to get shots of the roof, moisture detection services, rodent detection services, etc. Another part of the home inspection that people often don't take into consideration is that there's a good portion of it where the home inspector is actually teaching you how the home will work for you. So they're teaching you how to change your furnace filter, how often you should do so, how to adjust the thermostat. Some things that might seem silly, but in all honesty, are really good pieces of information to have when you do own a home. Most will also give you like an annual checklist and seasonal checklist. So like disconnecting the sump pump hose at this time of year, those sorts of things. So always good, always nice to have if you can. Number 13, I put this right after home inspection because it's often confused with a home inspection, but it's very different. An appraisal. So what an appraisal is nothing to do with a home inspection. They are not telling you all the things wrong with the home, not necessarily. They will note some negative aspects in their reports, but essentially what an appraisal is something ordered by the bank. And it's not common to see it ordered by the buyer here, although I hear in the States it's a big thing. But essentially what an appraisal is it's a certified appraiser comes in, walks through the property, and is doing up their own assessment of value. So when a realtor lists, they're usually doing a comparative market analysis for the home. An appraiser is doing something similar, but definitely more thorough of a report called an appraisal. They are going to report back to the bank and essentially tell the bank if what you are paying for this home is a fair price. So in the event, of course, that if ever you were to default on your mortgage, that they have that coverage. They're not underwater on the mortgage. God willing, you will not default on your mortgage, but it's a protection the bank puts in place. Also, funnily enough, and this might sound backwards, but we do see more appraisals in situations, I find, when there is 20% or more being given as a down payment. And that's because the banks don't have that underwriting insurance in place from the mortgage insurers. So what that means, though, is they don't have that to fall back on, so they do an appraisal for their own internal confidence. Number 14 is a property disclosure statement. So this is a voluntary questionnaire that you can ask the seller to complete. Some sellers will do it in advance of their home going on the market and just have it prepped. It has a whole slew of questions. If ever you want to see the questions, just let me know. I'm happy to send you a copy of it. But it really covers topics like, have you ever had issues with flooding, seepage? Has the home been a grow up? Have you done work without permits? Are you aware of any damage as a result of fire, moisture, insects, rodents? You name it, roof leakage. Are all the appliances working, etc. And then there's also always a catch-all question at the very end. But it really runs the gamut of different kinds of things you can have wrong within the home. And then we ask the seller to complete it and provide it. We can write it either as a condition in our offer, or we can attach it so that it forms part of our offer. But yeah, it's a voluntary statement that the sellers can fill out. Number 15 is title. So this is who legally owns the property. For us, we always pull the title for all of our listings just to make sure there aren't going to be any surprises down the road. Also on the title, we'll show any registrations against the property. So say there was a lien. People sometimes have those against their property. Perhaps they had a dispute with a builder and the builder has put a lien on the property. Perhaps they haven't paid their taxes. Perhaps the CRA has put a lien against the property. There are all kinds of ways to attach liens against a property, and it's good to know that before you're offering on a property so that you know there aren't going to be these hiccups. I have seen and witnessed a situation in which the seller owed so much money that the property could not actually be sold because the money they would have received from the purchase price didn't cover the debts that were registered against the property, including the mortgage. I use these two words interchangeably and maybe dangerously so, but contingencies and conditions. They are the same thing. It's just I find contingencies seems to be more commonly known, whereas conditions is a very Manitoba thing. But essentially what we're saying is the terms you've put in your offer to protect yourself. So say you are obtaining mortgage financing, you do have your pre-approval, which we talked about already, but say you are obtaining a mortgage, you still often will be putting in a financing condition, giving yourself a period of time to satisfy that condition. Typical is still around 3 to 5 business days in Manitoba. This is where a home inspection would count as a condition. A property disclosure, if we were requesting to see it, would be considered a condition. And a sale of home condition could also be inserted. Good luck getting it snuck through, but it's one of those things where you can insert them. So all the conditions that you can work into an offer can be put in there. And it's not just limited to this list. We actually have a checklist of all the different conditions you can have. So if ever you want a copy of that, let me know. Again, I'm going to include all my contact information in the comments section below so you can reach out. Conditional offer or conditionally sold. So a lot of the time we take for granted that everybody knows what this means, but it doesn't. So if you are submitting a conditional offer, it means your offer has conditions. It seems obvious, right? But if I am telling another agent, oh, sorry, we just accepted an offer, it's conditionally sold, that's so they know that we have accepted an offer, but it's not yet a done deal. Keep an eye on it. It could still fall through. Maybe the home inspection doesn't go so well, financing falls through, something like that. But in this conditional period, you are still working through things. Now, our offers say time is of the essence. We promise to push as hard as we can to move things forward and not waste anybody's time, essentially. But in that period, I want you to remember too that if your offer is still conditional, our deposits are refundable here. So you give a deposit with your offer, you hand it on over with your offer. The listing agent goes and deposits it into their trust account within 24 hours, and that money will sit in that account until closing, unless of course you aren't able to satisfy one of your conditions. So in the event, say the home inspection goes horribly wrong or you can't get financing, then you say, hey, Mr. Seller, I was unable to satisfy a condition. Please remit my money back to me, and they will. The only caveat to this is that in Manitoba, at least, if you give a deposit with your offer and then try to back out, we cannot release those funds for 10 business days. And I'm sure this is obvious, but because of fraud, there were a few situations I hear a few years ago where people would write offers, give a check with it, and then say, oh, can't get financing, give me my money back. But it turns out the original check was never any good anyways. Scammer's gonna scam. That's okay. But just know that that money is now tied up for 10 business days. So it's just something you want to factor in, because what if another house comes up on the market in that period that you're interested in? You're going to have to make some interim arrangements. That brings me to my next point, deposit. So I kind of touched upon it in the down payment section, but I just want to reiterate what a deposit is versus a down payment. So a deposit is the check you hand over with your offer. I know nobody carries checks anymore. Bank draft certified checks are acceptable, although in those situations, we usually get those very next day after our offer is accepted, because they are case specific. Once an offer has been accepted, you need to know the name of the brokerage that the check is being made out to and the amount, and that can change in negotiations or if you're looking at various houses, right? So that's fine. There are some options opening up more recently to do e-transfers, but it's still kind of hit and miss. I know that my brokerage will allow e-transfers into it, and then we will hold the funds and then remit a check on your behalf. But not all brokerages in Manitoba will do that. So just starting to think how to get the funds moved around. Keep in mind too that e-transfer rules are typically pretty strict. I have only ever had one client that was able to move quantities larger than $3,000 at a time, and I still don't know how he did it, but historically the e-transfer limit is $3,000 a day, and there are weekly limits there too. So ideally, if you have a personal check, that's actually the easiest, but if you don't have that as an option, just make sure you figure that out with your realtor, how you're going to get the funds to where they need to be when they need to be there. Now, the amount of the deposit, there's no pre-specified amount. You can write whatever you want on your offer. However, if you write a super low amount, expect a counter on that. And if you write a super high amount, hey, I don't think the seller's gonna complain, but keep in mind that that's interest you're losing. So talk to your realtor about what an appropriate deposit size is based on the price of the home you're purchasing, and then formulate a plan from there. Equity, my favorite, one of my favorite parts of real estate. So essentially, equity is the difference between what you could sell the house for in the market today and what you owe on it. Simple as that. So it's essentially money that is not being used or utilized, but is tied up in the home, which is great. It's an amount that tends to increase over time as you pay down the mortgage, as you make improvements to the home. We also call that forced depreciation sometimes. And then also as the market inflates over time, you're building that equity. So hopefully you're sitting on a ton of equity in that home. Most Winnipeggers are. Number 19 is condo fees. They're called condo fees here. In other provinces, they might be called strata fees or something else. I've mostly heard strata. But essentially, that's the amount you pay, and you don't have an option of the amount. You must pay it. It will be pre-specified in the listings, so you know what you're paying at least for the remainder of that fiscal year for the condo corp. And it's an amount you hand over monthly. There's a portion that usually goes to common expenses, so like snow removal, having somebody in to service elevators, etc. And then there's a portion of that should be going towards a reserve fund. So reserve fund is kind of this pot of money that the corporation is saving up for to be spent on capital intensive projects. So think like roofs, think like siding, think, stuff that a typical homeowner would have cash outlays for and should be setting money aside for. Now, what I always caution people on is condo fees are very, very revealing, especially if you look at the history of them over time. They're a good indicator of how well managed a property is. If we see these crazily increasing rates, low reserve funds, there's something amiss here. However, if we see slow condo increases on track with inflation year over year, that's usually a sign of better management. But yeah, again, this is one of those things where your realtor is going to come in and advise on that. Number 21, bidding wars. So in Manitoba, this is one that has been a hot topic for the last 2 decades, to be honest. Regardless of the interest rates over the last 20 years here, we have still seen bidding wars. So essentially what a bidding war is when more than one person wants to offer on a property. It's almost always fueled by a housing shortage. So it doesn't necessarily mean that there aren't any properties on the market, but maybe there's only so many pretty nice renovated homes on the market. It's often due to low inventory. And by low inventory, sometimes I say this and then people are like, yeah, but there's lots of houses out there sitting, which is true. There are houses right now as we're late fall 2023 that have been sitting. However, what I will say is that a lot of the time, if you pay close attention, you're going to notice that it's the super renovated homes that are not on the market for long. There's a lot of competition. And essentially what happens is there haven't been many of them come up, so buyers get excited. They see a home that doesn't need any work, and now they want to outdo one another in terms of writing competitive offers and bumping everybody else out. The highest bidder will often win, although not always. On our team, we've seen people win when they weren't the highest offer as a result of giving more attractive terms, so either reducing conditions altogether, although again there are risks inherent there, offering lease backs, or offering really long possession dates. Perhaps it's really attractive to someone to have 6 months to move. So money isn't always the key factor, but it is a factor. But there are other things you can do in a bidding war to make your offer more attractive. So by being able to navigate all these terms, you're going to be in a much better position to sit down with your realtor, write an offer, and know where they're starting. And if ever you want any of these checklists I've referenced today, feel free to reach out. I'll include my contact information in the box below, in the comment box below. Again, thanks for watching. If you found value in this content today, be sure to hit that like button. It really does help me in determining just what to record next. And of course, feel free to subscribe to our channel. It really does help seeing you guys watching more and more of these videos. I'm still shocked to this day that people are watching them, but thank you so much. My team has grown as a result of all the support because you guys appreciate it, I guess. So thanks again. Take care.